If you hold silver, you need to hear this because something important changed this week and it did not show up on your favorite price chart. It showed up in the plumbing, in the quiet mechanical layers most people never look at until they break. And the reason this matters is simple. When markets start whispering instead of shouting, that is usually when the real story begins. On the surface, silver looks fine. Price has been firm, headlines are noisy, commentators are arguing about targets, but underneath, the structure has tightened in a way that rarely happens by accident. Futures spreads have stopped behaving like relaxed, abundant supply. Lease rates have nudged higher in places that matter. Physical premiums in multiple regions are no longer drifting down just because inflation prints look calmer. In some cases, they're moving the other way, which is a red flag for anyone who understands how these pieces usually move together. None of these signals screams crisis by itself. Together, they suggest stress building in pockets that normally stay boring unless something is forcing them to move. And once stress starts building in the background mechanics, the market can reprice faster than the news cycle can explain. That is how a global margin call actually starts in the real world, not as a Hollywood explosion. As a quiet tightening of conditions that makes the same leverage suddenly feel heavier, the same hedges suddenly feel less efficient, and the same risk suddenly feel too expensive to carry. Here is the uncomfortable question hanging over this market right now. What happens if margin sensitivity increases across several asset classes at the same time, in a world where liquidity is more conditional than people want to admit? Because in that environment, silver doesn't have to be the cause of the stress to become the mirror that reflects it. Silver sits at a strange intersection. It is industrial enough to be demanded by the real economy, liquid enough to be used as a hedge, and small enough that flows actually move it. That combination makes it a stress sensor. And stress sensors tend to move first, and move hard, when the system shifts from confidence mode into risk control mode. This is why the next 24 hours can matter so much, even if nothing big happens in the headlines. A margin event is often a clustering of conservative decisions. Risk managers tightening at the same time, prime brokers reevaluating exposure at the same time, volatility desks repricing protection at the same time, funding desks widening haircuts at the same time. None of this needs a dramatic trigger. It just needs a market that is already stretched, already levered, already confident that liquidity will always be there when it's needed. History says that assumption holds until it doesn't, and when it falters unevenly. Silver has a habit of being right in the middle of those moments, not because it started them, but because its structure makes it react quickly when leverage gets uncomfortable. And that brings us to the title claim. Silver to the mid-90s, stackers winning, a margin call window. I'm not going to sell you certainty. Markets don't owe anyone a clean answer. What I will do is walk you through the mechanics that make an outsized move plausible without requiring a fairy tale catalyst. If these under-the-hood signals keep tightening, silver does not need a miracle to jump. It only needs liquidity to thin while demand stays stubborn. That is when prices stop moving like a debate and start moving like an auction. And in an auction, the price rises until someone flinches. The question is, who flinches first, the leveraged paper side, or the real-world side that actually wants the metal? To understand why a margin shock can hit silver so violently, you have to stop thinking about markets as buyers versus sellers and start thinking about them as balance sheets versus thresholds. Most large participants are not making emotional decisions about silver. They're managing portfolios full of correlated exposures, funded with leverage, collateralized with assets whose value is assumed to be stable, and governed by risk limits that can tighten quickly when volatility rises. In that world, a global margin call doesn't mean everything breaks. It means the cost of carrying risk rises across the system. And when the cost rises, positions get cut. Not because people changed their long-term view, but because the math changed. The cleanest early warning is often collateral behavior. When the same high-quality collateral starts being reused more aggressively, rehypothecated more often, stretched across more obligations, you're seeing a system trying to do more with the same base. That's not automatically sinister. It's how modern finance works. But historically, heavy collateral reuse tends to appear when conditions are tighter than the headlines suggest. And when conditions tighten, margin is the lever that forces adjustments. Silver sits in a particularly sensitive spot because silver futures are among the most leverage-sensitive instruments in commodities. A modest change in margin requirements, or even a modest change in how brokers apply haircuts and offsets, can force positioning changes quickly. That's why the 24 hours concept matters. If margin thresholds shift across a few linked products in a short window, you can get a sudden wave of de-risking that feels like a shock, even though the pressure built slowly. The mechanism is simple and brutal. A portfolio gets hit in one place, maybe equities, maybe rates, maybe FX. Margin usage rises. The risk manager doesn't want to add cash. They want to reduce exposure. So they sell what they can sell. They cut what is liquid. They reduce what has high margin impact per dollar. Silver is liquid. Silver is margin sensitive. Silver is often held as a hedge or as a tactical risk asset. That makes it a candidate for forced repositioning. Now here's where people get confused. They hear margin call and assume silver must crash. But silver can do both because silver overshoots during margin episodes. In a forced deleveraging wave, silver can dip sharply at first as paper positions are cut. Then it can snap violently higher if the underlying physical tightness and hedging demand remain, because the market discovers that the paper selling did not create real supply. This is why silver is infamous. It can whip both directions and still end higher because it's not just a trade, it's a structural asset with real-world demand underneath. If risk repricing forces shorts to cover while physical premiums stay firm, the rebound can turn into a squeeze. And squeezes are accelerated by the exact thing leveraged traders rely on: liquidity. In normal conditions, liquidity smooths moves. In stressed conditions, liquidity becomes conditional. Market makers widen. Balance sheet providers step back. Depth disappears. So a move that should be a few dollars becomes 10. A move that should take a week happens in an afternoon. That is how a sudden jump toward levels like the mid-90s becomes plausible without any magical news. It's not prophecy, it's reflexivity. Higher volatility raises margin. Higher margin forces position cuts. Position cuts, thin liquidity. Thin liquidity makes price jump. Price jumps trigger more risk control. Risk control triggers more forced buying or selling. And the loop feeds itself. And silver's small size relative to global capital is what makes it dangerous. Big markets absorb flows. Smaller markets reveal them. And when the system is stressed, revealed flows look like insane moves. They're not insane. They were simply what happens when thresholds get crossed in a market that can absorb the adjustment smoothly. Now let's bring the physical market back into the story, because this is where stackers win stops being a slogan and starts being a structural advantage. Paper can be created instantly. Physical cannot. And the silver market lives in the tension between those two realities. Industrial demand has not softened the way many people assumed it would. Solar installations, electrification, electronics, grid upgrades, and industrial fabrication continue to pull metal steadily, often quietly, without dramatic headlines. Meanwhile, mine supply growth has been incremental, not explosive, and above-ground inventories are not a single global pool you can tap at will. They're distributed, sticky, sometimes locked by policy, logistics, financing, or simple reluctance to sell. A market can look balanced on paper while experiencing localized tightness that pushes premiums higher. That's why premiums matter more than opinions. Premiums are the physical market speaking. Premiums say the metal you can actually get, when you can actually get it, is worth more than the screen price suggests. When you see physical premiums refusing to relax even as macro narratives calm down, that's a sign of underlying tightness. It means the physical side is not buying the no problem here story. And when physical and paper tell different stories, resolution is rarely smooth. It usually resolves through price moving to a level that changes behavior. Either higher prices reduce demand and attract supply, or lower prices trigger immediate buying and tighten things further. In a market with strategic and industrial demand, the second outcome is common. Dips become invitations. That's how you get violent rebounds. Now add the settlement layer. Futures markets function because most participants never intend to take delivery. They roll, they offset, they net out. Physical settlement is the exception. But exceptions become more important when incentives change. If the cost of rolling rises, if spreads behave oddly, if margin efficiency deteriorates, large players who normally avoid delivery start modeling it. They don't need to demand delivery to change the market. They only need to consider it seriously enough that their behavior shifts upstream. They hedge differently. They manage inventory differently. They tighten their tolerance for risk. And that upstream shift can tighten the market before any event happens. This is the boundary between trust and mechanics. The system works when trust does a lot of work. The moment trust is questioned, mechanics take over. Mechanics are colder. Mechanics don't care what you believe. Mechanics respond to incentives. Another underappreciated factor is logistics and financing. Arbitrage between regions is not automatic. It requires metal, transport, insurance, warehousing, and financing. In tighter credit conditions, financing is not guaranteed. If banks allocate balance sheet more selectively, warehousing costs rise, and regulatory scrutiny increases the cost of carrying commodities, then the normal shock absorbers weaken. That makes the physical market more sensitive to surges in demand. It also makes the paper market more sensitive to physical constraints, because the bridge between the two, arbitrage, becomes slower and more expensive. In that world, the screen price can lag reality longer, and when it finally adjusts, it adjusts in a hurry. That is why the idea of silver jumping during a margin window isn't tea fantasy. It is a plausible outcome when the market is tight enough that any surge in hedging or delivery preference collides with limited flexibility. The physical market doesn't need to run out for this to matter. It only needs to feel tight enough that participants behave more defensively. Industrial buyers pull forward purchases. Fabricators build buffer inventory. Dealers widen premiums because restock is less certain. Those small defensive moves, synchronized across many actors, can tighten the market more than any single headline. This is why physical holders have an edge in certain regimes. Physical holders are not forced to mark every hour. They are not subject to margin calls in the same way. They can sit through volatility that liquidates leveraged traders. And when volatility is driven by leverage mechanics rather than true supply relief, physical holders often come out stronger on the other side. That S what stackers win really means in a stress regime. Survival through the volatility that paper cannot tolerate, and benefit from repricing when mechanics force the market to admit tightness. Let's talk about the derivatives layer because it often tells you what the market fears before price admits it. One subtle shift you watch in stress building phases is options behavior. When implied volatility firms while realized volatility stays relatively contained, it usually means participants are paying for protection against moves that haven't happened yet. That is not the same as chasing momentum. It's hedging uncertainty. People aren't necessarily betting on up or down. They're buying optionality because the range of outcomes feels wider than normal. When optionality gets bid, it can feed back into futures through hedging flows. Dealers who sell options hedge dynamically. When price moves, they adjust. In calm conditions, this flow is manageable. In stressed conditions, it can amplify moves. If the market starts moving quickly and dealers are forced to hedge into the move, you get acceleration. This is one reason silver can feel like it teleports during certain windows. Another amplifier is pooled vehicles, ETFs, and systematic strategies. These structures are designed to track and respond. They do not exist to stabilize markets. When flows accelerate, they can become accelerants, especially in a market like silver, where physical backing or sourcing at scale is meaningful relative to daily supply. Again, that doesn't imply failure. It implies sensitivity. A sensitive market can move a lot on flow, even if the underlying industrial story changes slowly. Now, layer in correlations. One of the most overlooked drivers of margin events is correlation shifts. Hedges that were designed to be independent suddenly move together. A portfolio manager who thought they were diversified discovers they're not diversified when it matters. That's when risk managers take control. Not because anyone is wrong, but because survival is priority one. When risk managers dominate, markets can look calm, then suddenly move when thresholds are crossed. Silver sits in a unique position in that environment. It can behave like a commodity, like a monetary metal, or like alternative collateral depending on what kind of stress is driving the system. In a funding stress regime, the strong dollar means metals down rule can break. Metals can hold firm or rise because the stress is not growth optimism. It's a scramble for safety. And real assets, because physical demand doesn't care about the same correlations paper traders rely on. This is why simple narratives struggle. Inflation down, silver should fall. Dollar up, silver should drop. Those rules are shorthand for regimes that can change. If the regime shifts toward margin sensitivity and conditional liquidity, the rules get messy. And messy rules produce violent repricing. That brings us back to the idea of a level like $95. Treat it as a symbol, not a promise. It represents a zone where narratives collide. It's a psychological marker where shorts feel pain, where longs feel vindicated, where media starts paying attention, and where options hedging can become reflexive. In a sensitivity regime, price levels become magnets because positioning clusters around them. If the market pushes into that zone quickly, it can trigger a cascade of stop-outs and hedging flows. If it hesitates, it can consolidate and build more tension. Either way, the important point is not the number, it's the behavior as the market approaches it. Does volatility expand? Do premiums stay firm? Do spreads tighten? Does liquidity thin? Those are the tells. Those are the clues that the underlying mechanics are tightening. And when mechanics tighten, price doesn't need a headline to move, it needs a threshold to be crossed. The uncomfortable truth is that many of the stabilizing forces that used to soften moves are weaker now. Volatility sellers are more cautious. Banks allocate balance sheet more selectively. Warehousing costs are higher. Arbitrage is slower. Algorithms can withdraw liquidity quickly when parameters change. Put all that together, and you get a market that can feel stable until it suddenly isn't a T. That's what a margin window looks like. Not a guaranteed crash or guaranteed moonshot. A regime where the range of outcomes widens and the speed of adjustment increases. In that regime, silver's personality shows up. And silver's personality has always been the same. It humbles certainty. So where does that leave you right now, and what should you watch over the next day if you want to understand whether we re-entering a true stress phase or just a noisy week? The goal here is not to predict a single outcome. The goal is to observe interaction. First, watch the relationship between paper moves and physical response. If price moves up and premiums refuse to cool, That suggests real demand is not backing off. If price dips and premiums don't dip with it, that suggests physical buyers are treating dips as opportunities, not warnings. Second, watch volatility relative to price. If implied volatility stays bid while spot looks calm, the market is quietly paying for uncertainty. If volatility expands sharply, margin frameworks can respond, and that's where forced adjustments can begin. Third, watch spread behavior and the curve. Strange behavior in spreads, unusual tightness, or abrupt changes in near-dated dynamics can be clues that financing and roll incentives are changing. Fourth, watch the broader system. Margin events are rarely isolated. If correlations spike, if multiple assets start moving together for no clean fundamental reason, that's a sign balance sheet stress is driving decisions. And in a balance sheet-driven tape, logic gets replaced by thresholds. The tape moves because it must, not because it wants to. Now, let's address the emotional side, because this is where most people fail. In stress regimes, the greatest risk is not being wrong about direction. It's being forced out at the worst moment because you chose the wrong vehicle. Leverage turns volatility into existential risk. That's why physical holders often win through these phases. Not because they're smarter, but because they aren't forced to respond to the same margin pressures. They can sit. They can wait. They can watch the mechanics play out. Leverage traders don't get that luxury. They can be right long-term and still get liquidated short-term. That's the cruelty of margin. Now, I'm going to be careful with claims. Nobody can guarantee silver hits $95 in a clean line. Markets can overshoot and snap back. They can spike and reverse. They can do nothing for a week and then move in an hour. The point is not the certainty of a number. The point is the plausibility of a fast repricing when signals in the plumbing tighten at the same time. If margin sensitivity rises and liquidity thins while physical demand stays stubborn, silver is exactly the kind of market that can jump in a way that feels disproportionate to the headlines. That's why the 24 hours framing isn't prophecy. It's vulnerability. Systems that rely on confidence and leverage can absorb a lot until they can absorb quite as much as they did yesterday. When they hit that boundary, the adjustment can be fast. And silver, because it sits at the crossroads of industrial need, monetary hedging, and leverage mechanics, often reflects that boundary sooner than other assets. The bigger takeaway is this: don't underestimate complexity. Silver is not a simple inflation trade anymore, if it ever was. It's a market where physical and paper negotiate, where financing and logistics matter, where hedging flows can amplify moves, and where small pressures can align into outsized outcomes. If you want to be on the right side of this, stop chasing headlines and start watching the tells. Watch premiums, watch volatility, watch spreads, watch correlation behavior, watch liquidity. Those signals will tell you more than 1,000 opinions. And if the signals keep tightening, then the story is not about a single day. It's about a regime shift toward conditional liquidity, tighter collateral, and a market that's repricing risk. In that regime, the people who survive are the ones who respect mechanics, manage exposure, and refuse to confuse calm price action with a calm system. Because the system can look calm right up until the moment it isn't. And when that moment arrives, silver tends to move first, fast and without apology.